Welcome to the Monetary Policy Special. No rate cut, nor was it expected. But the big headline in this monetary policy is the MPC changed its stance from the hawkish withdrawal of accommodation to a more dovish neutral stance. However, the governor was very careful to dilute the dovish stance. Just hear him out.
The MPC considered it appropriate to change the stance to neutral and to remain, I repeat, and to remain unambiguously focused on a durable alignment of inflation with the target, while of course supporting growth.
Okay, he repeated that unambiguously about 4 times. Now also hear out Deputy Governor Patra when he spoke about the same issue.
We will like to see off the near-term hump in inflation, which all our projections suggest is going to happen. We want to see it off carefully before even considering the next move.
Now, what did Dr. Patra mean by the hump? Just look at the inflation numbers. June was 5.08. July, August, we got a 3% plus number. But the September and October numbers, I have just a dipstick poll. September is expected to be 5.2 and October is expected to be 5. These are the 2 numbers that the Reserve Bank will have when it goes on December 6th for its next policy. Very tough to cut with with 2 5% rates just behind you. So this appears to be a change in dovish stance with a liberal dose of hawkish. So it seems to me, but what's the impact? What's the takeaway for economists, bond market experts, and for bankers? I have with me an elite panel, SBI Chairman, Mr. C.S. Setty, Mridul Saggar, former MPC member and now Professor of Finance at IIM Kozhikode, B. Prassana, the Head of Global Treasury at ICICI Bank, and Samiran Chakraborty, the Chief Economist from Citibank India. Gentlemen, thank you very much for joining me in what should have been a busy day for all of you. Well, let me start with the bond guy first. Prassana, the yields have, I guess the market was taken by a pleasant surprise. What is the sense you are getting now? Will the market build a structural bullishness for bonds or, falling yields?
So I think, Latha, structural bullishness for bonds was already getting formed, right? We started the year much higher at 7 and we're already at 670s. But beyond that, I think into the policy, I would say roughly around 50% of the market participants kind of expected a change, while most of the others thought that he'll probably talk a little dovish outside the policy, but the change in stance will be in December and a rate cut might either be in December or in February. So to that extent, I think this change in stance was a little bit pleasant surprise for the markets. Frankly, there were 2 options that the governor could have done. He could have either, not changed the stance but talked dovish, or he could have changed the stance but acted really neutral in his talk. I think he chose to do the latter. And that's why in your introduction also you made the point about how neutral they are getting. So from all this, I think the trajectory of bond deals, I think, frankly, does not change much. We are still headed towards 650 or 655 probably by March of this financial year. But of course, whether the next rate cut is in the bag or it's not in the bag, like the hump that you're talking about, they will see 2 inflation readings which are on the higher side. But on the other hand, they would see Fed having cut. So there's a lot of things which happens between now and December. So I would place a higher than 50% probability of a December, but between December and February, definitely a cut of 25 basis points is there, and bond markets will start looking towards that possibility.
Okay, let me get one more opinion before I go to the banker and ask him what his troubles are with a falling rate. Samiran, your take. From what the governor said, the hedged dovishness, are you sensing December, or do you think he'll pass December and go to February for the first rate cut?
We think that by the stance change, the governor has got some flexibility, some optionality with him in terms of choosing the rate cut. But I don't think there is any guidance from today's policy about the timing of the rate cut. In December, the 2 inflation prints that will be with him will likely to be more than 5%. It would be much harder to cut rates in the December policy, according to us. What can change, and I think this is quite crucial, is that we will have some idea about how the festive season demand has played out. as well as by November end, we will have the September quarter GDP data. So to what extent that forces RBI to change its growth outlook would be critical. And the balance of risks between growth and inflation, which in this policy the governor mentioned as being well poised, whether that changes in the December policy is something that we have to see. In our baseline scenario, we are expecting the cut more to be February than December. In fact, there is a risk that it can be delayed further to April also if the growth numbers remain more comfortable and RBI decides to actually wait for the actual inflation numbers to fall to 4 and stay there, rather than work on the basis of forward-looking inflation to be meeting 4%. I think that is going to be quite critical.
Though he did insist that, expected inflation, he said it several times, almost as many times as he said unambiguously. So my sense is an expected inflation towards 4 should suffice. Just a word, Prassana says 6.55 by end of year, you said, right, Prassana? You agree with that, Samiran? The yields go to almost 6.5 by March?
Yes, we have a similar forecast.
Okay. Mr. Setty, that brings it squarely to you. Do you see this as a big problem? As it is, there will be a lot of your loans tied to T-bills and money market instruments. That will be priced lower. Corporates can go and borrow from the market. So do you have a problem that your borrower is able to dictate terms to you? Your depositor is also dictating terms to you. Do you have a problem?
Yeah, Latha, I think without getting into the nitty-gritty of it, but I think our portfolio, SBI portfolio, repo linked portfolio is less, and even T-bill linked is less. We have predominantly floating rate in terms of MCLR linked portfolio. That the transition in MCLR is slightly longer than what happens in kind of the rate cut is happening and the repo is reduced. But our view, I think we still hold on to the house view, and also the economists taking a view that the first rate cut probably will be in February. So, which means that the impact on the reduced rates on the floating rate loans will not be immediate. That is number one. Okay. Number two, the depositors demanding for higher rate, I think that is the question of supply and demand. As we keep saying, I think depositors definitely look for proper compensation. But the real rates of interest are better now when compared to what it used to be earlier. There has been readjustment of interest rate on deposits for the last few months. Today, I think banks are willing to pay 1 to 2 year deposit around 7.25% to 7.5%, giving a real return on the deposits.
Yes.
So in a way, I think these rates will continue for some more time. The rate cut happening in February is also a very interesting thing. You have not asked me, but I still would like to volunteer on that.
Yes.
That I think for the first time, the central bank probably would be, if central bank is confident that the growth rate of 7.2 or 7% is likely to be there in FY25 and FY26, we would have a very special situation where the rate cut will happen when the growth is good.
Yes.
So this is something which we witness in other countries also. I think it has happened in US, it happened in Philippines. So this shows confidence of central bank on the growth trajectory, which is a good tiding for us. While we will have some challenges on the rates, but I think the growth will compensate for that.
No, I am going to come full on the growth question as well. I had to take one at a time. But just a nitty-gritty, Mr. Setty, you will have to have the liquidity coverage ratio on you sooner or later. Now, will it be tempting for the banks to convert a bank like you, who is giving a lot of loans to AAA companies, to simply convert it into a bond? In that case, you meet your LCR requirements. Will it work that way and therefore some of your pain reduced?
No, I don't get how the lending and bond is going to help me in the LCR.
No, it'll count as HQLA, isn't it?
No. Corporate
okay.
bonds don't count for HQLA. Most of them don't.
Most of them don't.
But the G6 do.
Yeah, G6 will.
Yeah.
But Prasanna, isn't some level of HTM corporate bond likely to get counted as HQLA? No?
No, especially the bonds issued by the non-financial sector will get counted as HQLA. So to that extent, I think you can assume that the AAA bonds and the AA plus bonds, which are the most prominent issuers, are the ones who are likely to, benefit if the LCR guidelines were to come into play.
Okay. So, there was a banker telling me that that may be a window of relief because they will be able to convert some of their loans to, say, a Tata Steel or any other AAA company. Maybe not so many of them are bond issuers, but that could be a bit of a relief from the very high liquidity cover that banks will have to accumulate. Mr. Setty, I'll come to you in a minute. But Mridul, were you surprised by the neutral stance, the conversion to neutral stance? And what did you make of exactly the question that Mr. Setty has put on our plate? That at a time of high growth, 7.2 and 7.1, the Reserve Bank will go ahead and cut, you think? Say, even in February?
So, Latha, I was not at all surprised that they moved to neutral. I think it was a bit overdue to communicate that. What is important to note is that the stance has been changed after 19 months from February 23, and withdrawal of accommodation phrase has been dropped after 29 months.
Yes.
So that's important. And plus, central bank has returned to a neutral stance after a full period of 5 years and 4 months. So this is not without significance. It's not just incremental change that is there. Having said that, to your original question, whether the cut will come or not, that prognosis is still difficult, and my take is same as what the SBI was saying, probably in February. We have this comfort of low inflation, core inflation for quite some time. And if the headline falls towards the core, as it should be, I think there will be space to do a very shallow rate cut cycle. And that's what Reserve Bank seems to be preparing for. But that is not a certainty, as it was repeatedly said. There are a lot of uncertainties around, especially hinting at the geostrategic issues which can spike the oil price at any point of time, though RBI has reduced the oil price forecast because 85 was becoming very difficult with the kind of average
to
we
justify.
Yeah. So I think they're preparing for a window that if forward-looking data allows them, they can do some shallow rate cut cycle.
Okay. Fair enough. But even a shallow rate cut, even if it is 2 cuts, there are some people with 3. Okay, Samiran, that question to you. First of all, you're buying the 7.2 and 7.1 forecast, which the governor put on the table. The Reserve Bank is the highest on the street in terms of growth estimate. But they were last year as well. And it was the street which followed Reserve Bank. Reserve Bank was right. And today, the confidence with which, the emphasis with which the governor argued his 7.2 forecast was stunning, was telling. Have you changed your growth forecast? And therefore, what do you make of what Mr. Setty said, that we are going to get rate cuts in a strong growth cycle?
So, Latha, first, our numbers are marginally lower than what the RBI's numbers are. But I think the street is trying to be even lower than our 7% growth forecast. The primary reason is that the June to September quarter, we haven't actually seen the kind of pickup that we would have anticipated after the April-June quarter distorted by election and heat wave. RBI has acknowledged that and reduced their own number from 7.2 to 7 for this particular quarter, but has adjusted upwards the other 2 quarters for the rest of the year. So the overall number has remained the same. And there, I think the critical assumption is about government expenditure. Right now, to meet the full year capex target of the central government, for rest of the year, public capex has to grow at more than 40%. If we see that sort of a spend, then clearly the GDP growth numbers will look better. But if the government is unable to spend at that pace, then there is downside risk to the GDP numbers. And the other risk that we have to see, and over the next couple of months, we will probably have some anecdotal evidence on this, is on urban consumption. There is some signs of softness there, particularly what the number that I noticed was even the GST payment growth for the last month was only about 6%. We will have to see how that thing pans out. And by end November, when we get the September quarter GDP data, we'll know that to what extent the full year GDP growth number we can keep at around that 7% handle.
Okay. No, that's a fair point. But even the US GDP has been surprising on the upside. I mean, the last number was 3%. So somehow I'm more prepared for upside surprises in GDP. So that puts two questions actually to State Bank and the entire banking sector. They are 1/3 of the banking sector. First, how much will their margins crunch? How much will they be able to make up for it by a growth in the loan book itself? All those questions in a minute after a very short break. Welcome back to this Monetary Policy Special. I have been speaking with economists Mridul Saggar, former MPC member, Samiran Chakraborty of Citi, Prassana of ICICI, and the State Bank Chairman. Gentlemen, thank you very much for your patience. Before I go to Mr. Setty, Mridul, do you buy this optimism, 7.2 this year and 7.1 next year, despite some of the soft data we saw in the second quarter that Samiran elucidated very comprehensively?
Too early to say, but I see risks more on the downside to that number. It's quite possible that we eventually hit 7.2 if the transmission from global slowdown is contained. But at the moment, what I'm seeing is that the global trade numbers, the global growth numbers might just start getting to be affected, and one has to see how they translate. And you mentioned the GST weakness and also the PMI weaknesses. We know it's not weakness. PMIs are still strong, but relatively these numbers showed a slight deceleration. So we have to see more high frequency indicators. But more than that, the rate cut decision would depend on inflation, and inflation data for November will not be available to the December MPC meeting. It will be available to the February meeting, and unless the consumer price data, what the Department of Consumer Affairs collect, shows a significant drop in agriculture prices, a December cut would be ruled out, and it's more likely in February.
Yeah, okay, but you're saying that there are risks to growth on the downside.
Yes.
With that backdrop, Mr. Setty, what's the expectation first on loan growth? Given what the reserve, given the confidence of the governor in terms of growth numbers, do you think you all will do better than your forecasts on loan growth?
I don't say it's better than what forecast. I think most of the banks have given a credit growth rate forecast about 14-15%. There's slight moderation in August. If you see the numbers, I think the credit growth is around 13%. But the second half is generally a busy season for credit growth because of the festivals and many other things which come up in the second half, what we normally call busy season. Yes. So I believe that I think the credit growth will come back to 14-15% levels. Okay. What has been slight slowness in our moderation is in the consumption loans, the unsecured personal loans.
Yes.
For various other reasons, not necessarily because the lack of demand. I think.
No, I was coming to that, sir. It was as unambiguous as the growth forecast was the governor's worries about unsecured debt, not from banks so much, more NBFCs, HFCs and MFIs, but still that fear that loans have been given too cavalierly seems to be there. So given that, as well as the already probably falling demand, would this caution of lending, all that impact both the quantity and the amount of retail loans you will give?
Yeah, so the retail loan, again, various kinds of retail loans are there in the broader category of retail loans. The segment probably would continue to grow, home loans, auto loans. What is being impacted is the unsecured personal loans, capital allocation. And some of the segments of customers, they are price sensitive. Even if it is a good personal loan, they will not take if it is expensive. So as the risk weights go up, the rates also have to be passed on to the consumers. That is where I think some slowness is happening. It's also happening through the NBFCs and MFIs, where unsecured portfolio we see in the unsecured loan.
No, that makes two dampeners, right? The government may not be able to spend, as Samiran said, a 40% rise in loan year on year may be tough. Plus unsecured loan, you could be, a banker's lender's caution could also creep in. Just a word more, Mr. Setty, what about margins? How much do you think they will be hit from here on for the entire sector, really? Should we shave off 20, 30 basis points?
So again, I think, Latha, this discussion we've had earlier also on the compression of margins. The compression of margins differ from one bank or one lending institution to another based on the portfolio composition. And, there are portfolios where predominantly high-yielding retail loans, obviously there'll be some pressure. But I think well-diversified portfolios, what we are seeing is that every bank is trying to contain the cost of resources. Because obviously to get good quality customers, there's only so much you can increase on the rates of interest on the loans. So the cost of resources containment probably would help many of us to protect the margins, or at least to reduce the compression to the extent which is not very significant.
We're running out of time. Prassana, you gave me a headline on bonds, 6.5 by March, almost. What would be the headline on Rupee? Considering that, we are not going to cut much, according to you all, or not even soon, and it's a great growth story, are we in for some appreciation? What's the range?
So I think the headline on the Rupee can be given only by the governor, Latha. No market participant will be able to give it. But beyond that, I think we are stuck in a range. We are not able to appreciate when things are favorable and when inflows are coming, and not least because RBI also is there on the selling side. And on the other side, there is sometimes, for example, in the last couple of days, I'm sure there has been a lot, last 3-4 days actually, ever since the China stimulus has happened, there has been significant amount of outflows which are happening on the FPI side. And RBI has possibly been quite active preventing the rupee from depreciating beyond 84. So, which then means that you might not be able to let it appreciate also whenever flows come in. So we are going with a kind of a range-ish kind of a call on rupee. So very difficult to say. Again, like I said last time, the only confidence with which we can say is that possibly what is factored into the forwards market by way of depreciation, that does not get realized on the spot side on rupee.
Okay. Well, just 2 words from the economists. Samiran, 6% 10-year rate by when? 6% 10-year yield. Do we see it in 2025?
6% looks tough right now. Means and at a time when you will be cutting rates to 6%, generally the spread, the term premium starts increasing, and you might not actually, the bond yields might not go back to 6%. Okay.
My producer is putting a gun to my head. I can't ask anymore. Thank you very much, Mridul, Samiran, Prassana and Mr. Setty for joining me and parsing an all-important monetary policy. For us, it looks like growth is, the governor's optimism is not yet part of market chatter, and the expectations of rate cut are also pushed out beyond 2024. That's the big takeaway. Thank you very much for joining us on this special monetary policy wrap.